It is the morning after a historic silver surge, and millions of investors are staring at red numbers, confused how optimism turned into fear in less than 48 hours. Just days ago, silver was celebrating new highs, headlines screamed shortages, and confidence was everywhere, yet today the chart looks broken and sentiment feels suddenly fragile. This emotional whiplash is not accidental, because markets often inflict maximum psychological pain precisely when conviction is strongest and attention is lowest. To understand what is happening now, you must separate price from reality and short-term volatility from long-term structural pressure. Nothing fundamental about silver supply changed overnight. No massive discoveries occurred, and no industrial demand vanished during a holiday weekend. What did change was liquidity, because thin holiday trading creates a perfect environment for exaggerated moves that look catastrophic but lack real substance. During low-volume periods, relatively small sell orders can push prices dramatically lower, creating the illusion of a crash without genuine selling pressure. This phenomenon repeatedly appears during late December, when professional desks are empty and algorithms dominate short-term price discovery. In these moments, charts tell emotional stories that feel convincing but often contradict underlying physical market conditions. The silver market today reflects this disconnect, where paper prices react violently while physical demand remains tight and increasingly impatient. Experienced investors recognize these moments as stress tests designed to shake out weak hands before larger moves resume. Fear feels rational when prices fall quickly, but speed alone does not confirm meaning or permanence. The most important question is not why silver dropped today, but who benefits from convincing others that something is wrong. Large institutions thrive when retail investors panic, because emotional selling provides discounted inventory for patient capital. History shows that the most aggressive sell-offs often occur just before major repricing events, not after them. When everyone is watching the same red candle, few stop to ask whether the move reflects scarcity or merely temporary imbalance. This is where discipline matters, because reacting emotionally transfers value from the fearful to the prepared. Silver has always been a market of extremes, swinging violently before revealing its true direction. Understanding this cycle requires stepping back from minutes and hours, and instead focusing on weeks, months, and structural forces. What looks like collapse today may ultimately be remembered as the final pause before a much larger shift begins. To grasp the deeper forces at work, investors must look beyond screens and examine how silver actually moves through the global industrial supply chain. Silver is not merely a speculative asset, but a critical industrial metal consumed permanently in electronics, solar panels, medical devices, and advanced manufacturing. Unlike gold, most silver is not recycled efficiently, meaning demand continuously drains available above-ground inventory year after year. This structural consumption creates a market where supply shortages build quietly until price suddenly reacts. For years, paper markets masked this imbalance by expanding contracts far beyond available physical metal. As long as physical delivery was rarely demanded, price signals remained artificially stable and misleading. That stability begins to crack when industrial users compete directly with financial players for real metal. In recent years, green energy expansion has dramatically increased silver demand, especially from solar manufacturing. Each new generation of technology requires more silver per unit, not less, reinforcing long-term consumption pressure. Meanwhile, global mine production has struggled to grow, constrained by declining ore grades and rising extraction costs. Many silver mines are byproducts of other metals, limiting supply responsiveness to higher prices. This mismatch between growing demand and rigid supply forms the foundation of today's tension. Markets often ignore these realities until a catalyst forces participants to reprice risk rapidly. When that moment arrives, price adjustments are rarely smooth or orderly. Instead, markets gap violently as years of suppression unwind in days or weeks. The current volatility must be viewed through this lens, not as random chaos. Investors who understand silver's industrial role recognize why short-term dips rarely resolve long-term deficits. Price weakness in such environments frequently accelerates hoarding rather than easing demand. This behavior quietly tightens supply further, setting the stage for sharper future moves. To see this clearly, one must study where physical silver is being bought aggressively right now. One region in particular reveals the truth about silver's value, because physical buying there ignores Western paper volatility entirely. In Asian markets, silver is treated less as a trade and more as a strategic resource essential to national manufacturing security. When shortages appear, buyers respond immediately by paying premiums rather than waiting for prices to fall. This behavior contrasts sharply with Western trading culture, which often prioritizes leverage and short-term price action. As a result, silver prices can diverge dramatically between paper-driven markets and physically constrained ones. This divergence exposes where real demand exists and where pricing is merely symbolic. Physical premiums act as stress signals, revealing pressure hidden beneath calm futures prices. When premiums expand rapidly, it indicates urgency rather than speculation. Industrial buyers cannot wait for technical patterns to resolve because production lines do not pause. Every delay risks supply disruptions that cost far more than paying higher metal prices. This urgency forces buyers to secure inventory at almost any cost. Once this behavior spreads across industries, shortages accelerate quickly. Paper markets struggle to adapt because contracts cannot manufacture metal. This creates a widening gap between financial perception and physical reality. History shows such gaps eventually close violently in favor of physical pricing. Markets that ignore physical constraints eventually surrender control. The current silver divergence reflects precisely this process beginning to unfold. Those watching only Western charts miss critical information flowing from physical markets. This information quietly determines where prices must move next. Understanding this divergence is essential to interpreting today's volatility correctly. The widening gap between regions reveals a market no longer governed by a single global price. Instead, silver now trades in parallel realities shaped by access, regulation, and physical necessity. When metal cannot move freely, prices stop converging and begin reflecting local urgency. This fragmentation marks a turning point where logistics matter more than leverage. Investors accustomed to seamless arbitrage often underestimate how quickly markets can break apart. Once fragmentation begins, traditional price anchors lose authority. Futures exchanges continue printing numbers, but those numbers lose credibility without delivery confidence. Physical buyers instinctively sense this shift long before headlines acknowledge it. They respond by accelerating purchases, tightening supply further. This feedback loop reinforces higher physical prices regardless of paper volatility. Western markets, slow to adjust, interpret fragmentation as temporary noise. That misinterpretation creates opportunity for those who recognize structural change early. Price suppression becomes increasingly expensive as physical withdrawal accelerates. Eventually, maintaining artificial pricing requires extreme measures. Such measures signal weakness rather than strength. The silver market has entered this phase, where control costs rise daily. Each attempt to force prices lower exposes how little metal remains available. These stress points accumulate quietly until confidence suddenly breaks. When confidence breaks, repricing is abrupt and unforgiving. Understanding fragmentation explains why current volatility precedes, rather than negates, a major move. As fragmentation deepens, institutional behavior becomes increasingly revealing rather than reassuring. Large players rarely panic publicly, but their quiet accumulation patterns speak louder than headlines. When prices fall sharply without fundamental change, institutions often treat the move as inventory clearance. This is because long-term capital prioritizes access to assets, not emotional price validation. Sudden volatility provides cover for repositioning without attracting attention. During thin liquidity, strategic buyers can acquire size without chasing price higher. This environment favors patience, discipline, and conviction over speed. Retail participants, however, experience the opposite incentives under leverage and margin pressure. Forced selling transfers assets from weak balance sheets to strong ones. This transfer process is a recurring feature of every major commodity cycle. Silver's current setup mirrors historical episodes where control shifted rapidly. In those moments, institutional books quietly flipped from short exposure to long dominance. By the time price confirmed the shift, inventory was already locked away. Observers who rely solely on price miss the accumulation phase entirely. True confirmation arrives only after supply becomes inaccessible. At that point, price reacts violently because there is nothing left to sell. This explains why rallies often feel sudden, unfair, and impossible to chase. They are not born from enthusiasm, but from exhaustion of supply. Silver's volatility today reflects the final redistribution before scarcity asserts control. Understanding this process clarifies why discomfort precedes opportunity in commodity markets. As supply tightens, market narratives shift rapidly from denial to justification. Early warnings are dismissed as noise until physical shortages force acknowledgement. By then, prices already move beyond comfortable entry points. This pattern explains why commodity repricings feel sudden and unforgiving. Silver's role in energy transition magnifies this effect dramatically. Governments cannot pause electrification plans due to price volatility. Industrial buyers therefore absorb higher costs to maintain production continuity. This behavior creates an inelastic demand floor beneath prices. Once established, that floor rarely collapses. Market participants anchored to outdated price expectations are left behind. Attempts to short scarcity-driven markets historically fail. Each dip attracts stronger hands rather than resolving imbalance. This dynamic transforms volatility into fuel instead of resistance. Silver now trades less like a commodity and more like a strategic input. Strategic inputs reprice in steps, not smooth curves. These steps often occur during moments of maximum disbelief. The current environment matches those historical conditions closely. What feels chaotic is actually a structured transition. Understanding this transition reframes fear as information. The market is signaling preparation, not collapse. Timing matters most when structural forces overpower short-term mechanics. Calendar effects amplify these transitions by concentrating liquidity shifts. When markets reopen after inactivity, suppressed pressures release quickly. This release often appears as gaps rather than gradual movement. Participants positioned early experience validation rather than surprise. Those reacting late face emotional and financial stress simultaneously. Silver's setup suggests such a release window approaching rapidly. Regulatory changes intensify this process by restricting material flow. Once regulations activate, behavior changes overnight. Markets reprice based on access, not intention. Liquidity returns magnify rather than stabilize early moves. Volume confirms direction rather than setting it. This is why waiting for confirmation often means missing repricing. Early positioning requires tolerance for uncertainty. That uncertainty is the cost of asymmetric opportunity. Silver's volatility reflects this asymmetry clearly. Upside potential expands while downside becomes increasingly artificial. This imbalance rarely persists for long. Resolution tends to be swift and decisive. Understanding timing separates participation from observation. Every major repricing ends with a transfer of belief from skeptics to participants. Silver's story has repeated across centuries with remarkable consistency. Scarcity always asserts itself eventually. Price is simply the messenger, not the cause. Attempts to suppress reality only compress its release. When release occurs, it reshapes expectations permanently. Markets remember scarcity long after volatility fades. Participants who endure uncertainty gain structural advantage. Those who chase certainty pay a premium. Silver's current moment reflects this timeless pattern. The noise will fade, but the signal will remain. Strategic assets do not apologize for volatility. They reward preparation, not prediction. Understanding structure replaces fear with clarity. Clarity enables patience. Patience allows participation in repricing. Repricing confirms discipline. Discipline separates outcomes decisively. Silver stands at that threshold now. History suggests the window closes quickly once recognition arrives.